October 29th, 1929, Black Tuesday. Outside the New York Stock Exchange, crowds gathered in stunned silence. Traders who had arrived that morning as wealthy men left as broken ones. Fortunes accumulated over decades evaporated in hours. The ticker tape ran so far behind actual trading that investors didn't know what their holdings were worth, only that the number was falling and falling and falling. Newspapers would later report suicides, men who had leveraged everything, their savings, their homes, their futures, on a market that had promised only upward movement, now facing a reality they could not survive financially or psychologically. This is the story most people know about 1929, but it is only half the story. Because in quiet rooms, far from the pandemonium on Broad Street, a very different scene was unfolding. Men who had spent months preparing for exactly this moment were watching their calculations prove correct with the precision of a Swiss timepiece. Phone calls were being made, orders were being placed, positions were being closed, and fortunes, enormous, life-defining, historically significant fortunes, were being made. Where did all the lost money go? It didn't vanish. Money never vanishes. It transfers. The question that most histories of the Great Depression fail to ask with sufficient seriousness is, transferred to whom, and how did they know to be positioned to receive it? That is the story we are going to tell today. Part 1. The shoeshine boy indicator, the exit strategy. Joseph Kennedy was not a sympathetic figure by most historical accounts. He was ruthless, politically cunning, and possessed of a moral flexibility that allowed him to operate comfortably in spaces where most people would feel the friction of conscience. He was also, when it came to financial markets, extraordinarily perceptive. The story, possibly apocryphal but instructive regardless of its precise accuracy, is well known in financial circles. In the months before the 1929 crash, Kennedy stopped to have his shoes shined. The shoeshine boy, making conversation, began offering stock tips, specific companies, specific reasons to buy. The confident predictions of a person who has watched the market go up long enough to believe it will always go up. Kennedy listened. Then he went home and began selling. The logic was simple and devastating. When the shoeshine boy is giving stock tips, the information has reached its final destination. Every potential buyer who could be convinced to buy has already bought or is about to buy. The pool of new money that could push prices higher has been exhausted. The only direction remaining is down. This concept, the idea that markets peak when participation reaches its maximum extent, when the last available dollar of the most unsophisticated investor has been drawn in, is one of the oldest and most reliable observations in the history of financial markets. The 1920s bull market had done something remarkable. It had democratized stock market participation in a way that America had never seen before. Installment buying, with the ability to purchase stocks on margin, paying only a fraction of the actual price up front, had opened the market to people who had never previously participated. A factory worker could buy $50 worth of stock by putting down $5. A clerk could build a portfolio on borrowed money. The market seemed to offer something that no previous economic era had provided, a mechanism by which ordinary people could participate in the wealth-creating machinery of industrial capitalism. What it actually offered was leverage, and leverage in a declining market is not a tool of wealth creation. It is a mechanism of wealth destruction. While ordinary investors were borrowing to buy, the people who understood markets were watching the leverage ratios with growing alarm. The margin debt accumulated in the American financial system by 1929 was extraordinary. Investors had borrowed billions to buy stocks at prices that only made sense if the prices continued rising. The smart money, the term used in financial circles for sophisticated investors who understand market dynamics deeply enough to anticipate turning points, began exiting. Not dramatically, not in ways that would trigger panic and accelerate the correction before their exit was complete. Quietly, methodically, selling into the continued buying of the investors who were still convinced the market had further to run. Kennedy sold his stock positions throughout 1929. He also began selling short, borrowing shares and selling them, committing to buy them back later at what he anticipated would be a lower price. By the time Black Tuesday arrived, he was positioned not to lose money in the crash, but to make it. The shoeshine boy gave him the signal. The margin debt gave him the confidence. The quiet, methodical exit gave him the fortune. This is the first mechanism of the 1929 wealth transfer, not dramatic market manipulation, not illegal conspiracy. The straightforward application of understanding that markets overshoot, that leverage amplifies both gains and losses, and that the exit strategy of sophisticated investors is to sell when everyone else is still buying. The winners of the 1929 crash did not cause the crash, but they read its approach clearly, positioned themselves accordingly, and profited from the transfer of wealth that the crash produced. Part 2. Betting Against America, the Great Bear. If Joseph Kennedy represents the quiet, methodical sophistication of the exit strategy, Jesse Livermore represents something more dramatic, more aggressive, more perfectly calibrated to the specific dynamics of the 1929 collapse. Livermore was known on Wall Street as the Great Bear, a trader of legendary skill and equally legendary volatility. He had made and lost multiple fortunes before 1929, whose understanding of market psychology was so refined that he could read the internal dynamics of a market with an accuracy that bordered on the uncanny. By 1929, Livermore had spent months analyzing the market and reaching a conclusion that most of his contemporaries found extreme. The American stock market was not merely overvalued, it was structurally vulnerable in ways that made a catastrophic correction not just possible, but inevitable. The mechanism through which he intended to profit from this conclusion was short selling. Short selling, in its basic mechanics, involves borrowing shares from a broker, selling them at current market prices, and committing to return the same number of shares at a later date. The short seller profits if the price of the shares falls between the moment of sale and the moment of repurchase. The greater the decline, the greater the profit. In a market held up by margin debt and collective optimism, short selling is a bet that the collective optimism will eventually fail to sustain the prices it has created. It is a bet on reality reasserting itself against the narrative. Livermore began building his short position months before the crash. He was not operating on inside information in the modern regulatory sense. He was operating on analysis, detailed, systematic, ruthlessly logical analysis of market internals, margin levels, and the psychological dynamics of a market that had been rising long enough that most participants had stopped questioning whether it could fall. He also understood that markets do not simply decline. They decline in ways shaped by the structure of the leverage within them. As prices fall, margin calls force investors to sell, not because they have made a rational decision to exit, but because their brokers are legally required to demand additional collateral when the value of their holdings falls below a threshold. Those forced sales accelerate the decline. The acceleration triggers more margin calls. The cascade has a mechanical quality that, once begun, is very difficult to interrupt. Livermore anticipated the cascade. He positioned himself to benefit from its specific dynamics. When the crash began in October 1929, Livermore's short positions produced returns at a speed and scale that were almost incomprehensible. As prices fell 50%, 60%, 70% from their peaks, his profits mounted with each tick downward. By the end of 1929, Jesse Livermore had made approximately $100 million from his short positions. In the purchasing power of 1929, this was an almost inconceivable sum, equivalent to well over $1 billion in contemporary terms. He did not celebrate publicly. He understood with the psychological acuity that made him exceptional as a trader that a man who has just made $100 million while his neighbors are losing their life savings should exercise discretion. The mechanics of what Livermore did are worth examining carefully because they have not changed. Short selling is legal. It is regulated, but it is legal. It is a mechanism through which sophisticated investors can profit from declining prices. In a market where prices have been inflated by leverage and collective optimism, the short seller is, in a sense, the mechanism through which reality reasserts itself. The correction would have occurred regardless of whether Livermore was positioned to profit from it. But the wealth transferred by that correction did not disappear. It moved from the accounts of leveraged investors who were forced to sell into falling markets to the accounts of traders who had anticipated the direction correctly and positioned themselves accordingly. $100 million. Made in a single catastrophic week by a single trader who understood what most of his contemporaries did not. This is the second mechanism, not exit strategy, but active positioning, the deliberate construction of investments that profit from the very dynamic that destroys the investments of others. Part 3. The Vultures of Wall Street. Cash is king. The third mechanism of the 1929 wealth transfer operated on a longer time horizon and produced wealth accumulation that, in aggregate, exceeded even the spectacular profits of the short sellers. It required only one thing: cash. Specifically, cash held patiently through the peak of the market, through the crash, and into the years of the depression that followed. Cash that was available to deploy when the prices of real assets, companies, banks, real estate, railroads, industrial infrastructure, had been driven to levels that reflected not their intrinsic value, but the desperate need of their owners to sell. The Depression created sellers who had no choice, banks that needed to liquidate assets to meet depositor withdrawals, companies that needed to sell divisions to service debts they could no longer refinance, wealthy individuals who had leveraged their real assets to fund stock market speculation and now needed to sell those assets to cover their losses. Against these desperate sellers stood a small number of buyers with liquid capital. And in a market with many desperate sellers and few liquid buyers, the buyers set the price. J.P. Morgan, The institution, not the man who had died in 1913, was among the most significant of these cash-positioned acquirers. The Morgan banking interests had watched the speculative excess of the 1920s with the institutional caution of organizations that had survived multiple financial cycles and understood that what rises without fundamental justification must eventually correct. They were not perfectly positioned, no institution was, but they had maintained liquidity through the peak that allowed them to operate as acquirers rather than sellers in the post-crash environment. The assets they acquired, banking interests, industrial companies, infrastructure assets, were purchased at prices that reflected the depression of asset values rather than their long-term productive capacity. The factories still existed. The railroads still ran. The companies still had customers and products and operations. What had changed was the price at which a desperate seller would transfer ownership. John D. Rockefeller, then in his 90s, reportedly began buying stocks in the early stages of the crash, telling reporters that he saw no reason for the price decline in fundamentally sound companies. This was not altruism. It was the observation of a man who had spent his life understanding the difference between price and value, and who recognized that the crash had created a profound divergence between the two. The purchases made by cash-rich elites in the years between 1929 and 1933, as asset prices continued to fall through the depths of the Depression, produced returns over the following decades that represented some of the most significant wealth creation in American financial history. Not because these buyers were smarter than everyone else in every respect, but because they had maintained liquidity when everyone else was leveraged, which gave them the ability to act as buyers in a market full of desperate sellers. Cash in a crisis is not a conservative position. It is an aggressive one. It is the accumulation of purchasing power during the period when purchasing power has its greatest advantage over assets, when the ratio of desperate sellers to liquid buyers is at its most extreme. The Great Depression-era fortunes were not made in the 1920s bull market. They were made in the years of the crash and its aftermath by people who had the discipline to hold liquidity when the market was rising and the clarity to deploy it when the market was falling. The climax. The formula hasn't changed. October 29th, 1929. The mechanism operated in 3 layers. The exit layer. Sophisticated investors reading the signals of peak market participation and quietly selling into continued buying, positioning themselves in cash or short before the correction arrived. The short layer. Traders who anticipated the specific dynamics of a leverage-driven crash and positioned themselves to profit from the cascade of forced selling that margin debt would produce. The acquisition layer, cash-rich individuals and institutions who waded through the crash and into the Depression, deploying liquidity to acquire productive assets at prices reflecting desperation rather than value. These 3 layers produced an enormous wealth transfer. From the millions of ordinary investors who had participated in the bull market on leverage, who were forced to sell into a falling market, who lost their savings, their homes, and in many cases their livelihoods, to the small number of investors who had read the dynamics correctly and positioned themselves to receive. Now ask the question that makes this history something other than a historical curiosity. Has the formula changed? In 2008, sophisticated hedge funds had spent years before the crash identifying the structural vulnerability in the mortgage-backed securities market. They purchased credit default swaps, instruments that paid out when mortgage bonds failed. When the housing market collapsed and the financial system fractured, those funds made billions while the broader market lost trillions. The mechanics were different, the formula was identical. In 2020, as the pandemic triggered one of the fastest market declines in history, the same dynamic unfolded in compressed time. Markets fell dramatically in March. Cash-positioned investors and institutions deployed capital into the decline. By the end of 2020, the same investors who had maintained liquidity through the uncertainty had accumulated positions in companies whose prices had been temporarily divorced from their long-term value by panic. The specific instruments change. The regulatory environment evolves. The assets involved vary with the era. The formula does not change. Markets overshoot in both directions. Leverage amplifies the overshoot. When the correction arrives, wealth transfers from the leveraged and unprepared to the liquid and positioned. The mechanism has operated in every significant financial crisis in the history of modern capitalism. Jesse Livermore made $100 million in 1929 because he understood what the market was before most people recognized it. The sophisticated funds that profited from the 2008 mortgage crisis understood what the mortgage market was before regulators, rating agencies, or the broader public recognized it. The formula is not secret. It is not hidden. It is documented in the history of every significant financial crisis. What is not widely understood is that every financial crisis produces both losers and winners, that the wealth that appears to vanish in a crash does not actually disappear, that it transfers through the mechanics of short selling, through the deployment of patient liquidity, through the acquisition of distressed assets to those who had positioned themselves to receive it. Understanding which side of that transfer you're on in any given market environment is perhaps the most consequential financial question that most people never think to ask. October 29th, 1929, Black Tuesday. The crowds outside the New York Stock Exchange were experiencing one side of the largest wealth transfer in American history to that point. In quiet rooms elsewhere, the other side was being experienced. The money did not vanish. It transferred. Through mechanisms that were legal, that were available to anyone with the knowledge and the discipline to use them, and that have been used in every significant financial crisis in the century since. The formula is in the historical record. The mechanics are documented. The names of the people who applied them and the fortunes they produced are publicly known. What most people were never taught is how to read that record and understand what it means for the financial environment they operate in today. Now you have started to read it. If this gave you a new perspective, subscribe to Economic Chronicles, the hidden architecture of money and power. We show you where to look.